The swift unfolding of bank vulnerabilities. Bank collapses can happen much quicker than anyone anticipates. In the world of finance, especially when examining banks with assets ranging between $200 billion and $900 billion, there is a significant level of vulnerability. To understand the situation better, it's helpful to categorize banks into three tiers: small community banks. These banks are typically sound. Some of them, like a bank founded in 1877 that I personally use, have weathered historical crises such as the Panic of 1907, the Great Depression, and the 2008 financial meltdown. They may be safe for depositors, but it's essential to review their balance sheets and do your homework. Two big-to-fail institutions. These include globally systemic important banks like JP Morgan, Morgan Stanley, Citibank, and Goldman Sachs. While these banks won't fail due to their enormous size, stockholders can still lose a significant amount of money if the bank's equity takes a hit. Banks in between. These mid-tier banks, often holding between $200 billion and $900 billion in assets, are the most vulnerable. They aren't too small to be community-focused, nor too big to fail, which leaves them exposed to collapse. Many of these banks have a large proportion of uninsured deposits, which makes them especially risky. Uninsured deposits. A key risk indicator, a crucial ratio to assess the stability of a bank, is the percentage of insured deposits versus total deposits. Deposits over $250,000 aren't covered by the FDIC unless special arrangements are made. For instance, Silicon Valley Bank, which collapsed in March 2023, had only 3% insured deposits, meaning 97% of their deposits were uninsured. This made them highly vulnerable to bank runs. Many tech companies, like Cisco and various Bitcoin custodians, kept their cash in Silicon Valley Bank, often in billions. During a bank run, depositors with uninsured deposits can swiftly move their funds through online banking, triggering a modern-day equivalent of the 1930s panic, but at the speed of light via cell phones. Gold and currency. A reflection of the dollar's strength. When we see the price of gold rising, it's often less about gold itself and more about the weakening of the US dollar. Despite the dollar showing strength against other currencies like the euro and yen, a rising gold price signals trouble for the dollar. All fiat currencies, like the dollar, are forms of debt. In contrast, gold holds a unique position. It is a form of money that isn't tied to debt. This distinction makes gold an accurate barometer of the dollar's real value. As the US debt soars past $35 trillion with a debt-to-GDP ratio over 130%, it signals a precarious situation for the dollar. This growing debt load won't lead to an immediate collapse, but it indicates slower economic growth and the possibility of long-term stagnation, akin to Japan's long depression since 1989. In the US, we've been experiencing similarly depressed growth since 2007, with sluggish economic expansion and periodic recessions. Bank failures. A growing concern. The collapse of several banks, such as Silicon Valley Bank, Signature Bank, and First Republic, shook the financial system in 2023. The Federal Reserve and FDIC stepped in, guaranteeing all deposits and creating special facilities to allow banks to borrow against U.S. Treasury securities, regardless of market value. This prevented further bank failures, but it raises a crucial question. What happens when the next crisis hits? What comes next? The tools that saved the banking system in 2023 Guaranteeing all deposits and offering loans based on the face value of securities won't be available forever. If another crisis hits, the options for regulators are limited. They may nationalize the banks, which would wipe out stockholders but protect depositors. Stockholders need to be aware of the potential risks, as their investments could be reduced to zero if another financial meltdown occurs. The boiling point of political tension. Imagine a pot of water on the stove. At first, nothing seems to happen, but as the heat builds, the water starts to bubble, and eventually, steam rises. This analogy mirrors the current political climate in the United States. The temperature has been rising for years, and while things may seem calm on the surface, it feels like we're approaching a tipping point. Tensions have simmered, particularly among Trump supporters, who, despite what the media may portray, have shown remarkable restraint compared to the turmoil seen during the George Floyd protests in 2020. In 2020, while Antifa and BLM protests were widespread, fueled by frustration, and in some cases encouraged by political figures like Nancy Pelosi, Trump's supporters remained relatively calm. Trump himself called for deploying the National Guard, but Democratic governors refused. On the contrary, figures like Kamala Harris were raising money for BLM bail funds. Yet, despite the restraint, the threat of unrest remains. If something as drastic as an assassination attempt on Trump had succeeded, it's possible we could have seen the country descend into violence or even civil war. A silent civil war? Some analysts believe we are already in a civil war of sorts, though not fought with guns and violence, but in the courts and at the ballot box. There's a limit to how much people can endure, and while we haven't seen violent uprisings from Trump supporters, human nature suggests there's only so much pressure they can take. If the political landscape continues as it is, could we see something more severe? Possibly. While no one supports violence, the possibility remains that frustration could eventually boil over into conflict. The looming recession, a reality check. We might already be in a recession. Though no official declaration has been made, the warning signs are all there. The National Bureau of Economic Research often declares a recession after the fact, sometimes a year after it has begun. For over 2 years, the U.S. Treasury yield curve has been inverted, a key indicator of a recession. Typically, shorter-term interest rates are lower than long-term ones, but recently the reverse has been true, signaling that investors are betting on a downturn. Now, the yield curve is starting to revert to a more normal upward slope, which suggests we are not just heading into a recession, but already in one. Car sales are falling, housing is becoming unaffordable, and unemployment data is unreliable. There are 2 surveys used to gauge job growth: the employer survey and the household survey. They have been showing conflicting results, with one showing job creation and the other showing job losses. Historically, the household survey has been more accurate, and if this trend continues, we could see a sharp decline in job creation soon. Stock market bubbles and risks. While some focus solely on politics and the Federal Reserve, the broader economy is much more complex. The idea that a president or the Fed can quickly fix the economy is a myth. Sure, policies like tax cuts or reducing regulation can help over time, but they don't change things overnight. A recession may already be here, and if not, it's right around the corner. The concept of a soft landing is misleading. When the economy slows, the landing is always hard. In the stock market, we're in a bubble, whether people acknowledge it or not. It's easy to spot bubbles in retrospect. Think of the NASDAQ in 1999 or the housing market in 2007. But predicting when they'll burst is far more difficult. Right now, the S&P 500 is heavily reliant on just a handful of companies like Microsoft, Nvidia, Amazon, and Apple. These companies are driving nearly all of the index's gains, creating a feedback loop where rising stock prices push more people to buy, inflating the bubble further. When it bursts, it will happen quickly and painfully. For those invested in the market, this is a time to be cautious. Increasing allocations to cash and gold might be wise, with a special focus on sectors like energy and defense. As geopolitical tensions rise, defense contractors will likely see growth, particularly as the war in Ukraine continues and our weapons systems prove less effective than expected. The dark side of AI. Artificial intelligence, AI, is undoubtedly powerful, with the potential to revolutionize industries and society. But there are significant dangers that are often overlooked. AI can accelerate economic panics, increase bank runs, and lead to market crashes. In the realm of national security, particularly in nuclear warfare, AI could make the threat of annihilation more likely. Many experts discuss the wonders of AI, but few focus on its darker implications. The combination of AI and human nature, our fears, greed, and unpredictability, could amplify existing risks. AI systems, functioning exactly as designed, could unintentionally increase volatility in financial markets or exacerbate geopolitical tensions. While tools like GPT may seem like novelties, the larger scope of AI has far-reaching consequences that we must address before it's too late. Conclusion. We stand at a crossroads in both politics and the economy. Political tensions are high, and while civil unrest hasn't yet erupted, it's not an impossibility. Economically, the signs of a recession are all around us, and the stock market bubble is bound to burst. Add the rise of AI into the mix, and the future becomes even more uncertain. It's a time for caution, both in investment and in politics, as we navigate these uncharted waters.